Maritime Academy. Law of Marine Insurance, Part 5. Valued and unvalued policies. Valued policies. A valued policy is defined in Section 27(2) as a policy which specifies the agreed value of the subject matter insured. The purpose of fixing in advance the amount of compensation to be paid to the assured is to avoid disputes as to the value of the subject matter insured. Of course, all is well and good if a fair and realistic figure is given as its valuation, but as to be seen, past cases have shown that the agreed values tended to be inflated and exorbitant. Agreed value is conclusive. The rule is now embodied in Section 27(3) of the Act, which states, "Subject to the provisions of this Act and in the absence of fraud, the value fixed by the policy is as between the insurer and the assured conclusive of the insurable value of the subject intended to be insured, whether the loss be total or partial." Whether the subject matter of insurance be ship or goods, the valuation is the amount fixed by agreement, at which in case of loss, the indemnity is to be calculated. For instance, where goods are assured, the valuation may be low when the policy attaches, but the value to the owners may be enhanced when the goods have nearly reached their destination by the expenses of transit, etc. Yet the valuation is binding. And again, if the valuation be high, but the goods are depreciated in value from fall of market or other causes for which the underwriter is not liable, the valuation cannot be opened. The conclusive nature of the agreed valuation is binding even if unbeknown to the parties. The ship was considerably damaged, and the agreed value no longer reflects her real value. Once a policy, voyage or time, has attached, the agreed value prevails whatever the actual value of the vessel might be at the time. It cannot depend upon the actual value at the time of the loss or at the time the risk attaches. Insofar as the conclusive nature of the valuation is concerned, no distinction is to be drawn between a time and a voyage policy. For better or for worse, the agreed value is conclusive. As between the insurer and assured. In Assess Balmoral v. Martin, 1902, the insurers, who were asked by their assured to reimburse them their share of general average, which they had contributed, were held liable to pay only that proportion of the salvage and general average losses, which the policy value bore, to the proved or real value of the ship. Lord Shand was adamant that, in all questions of indemnity, therefore, the parties to the policy insurers and insured have agreed that though the ship may in truth be much more valuable, her value is to be taken at £33,000 only. There is no exception. The agreement is to apply in all cases of indemnity which may arise. The agreed value was £33,000, but £40,000 was taken as the value in the salvage proceedings. The insurers were only bound to pay 33/40ths of the ship's contribution. Scrapping voyages. A vessel which has, during the course of a time policy, to make a journey, referred to as scrapping voyages, to a scrapyard or other place for the purpose of being broken up or being sold for breaking up, will be governed by Clause 1.5 of ITCH 95, the relevant part of which states, "Any claim for loss of or damage to the vessel occurring subsequent to such sailing shall be limited to the market value of the vessel as scrap at the time when the loss or damage is sustained, unless previous notice has been given to the underwriters, and any amendments to the terms of cover, insured value, and premium required by them have been agreed. Unless previous notice and arrangements have been made, the scrap, and not the agreed value of the vessel at the time of loss, is to be taken as the figure for settlement of any claim for loss or damage. This is a contractual exception to the general rule contained in Section 27 of subsection 3 that the agreed value is conclusive. If the policy is unvalued, the scrap value and not her value at the commencement of the risk, Section 16(1), is also to be applied. Excessive overvaluation. The rule that the agreed value in a valued policy is binding and conclusive is firmly established. It was always thought that the value should never go beyond what is reasonable and fair, and the assured is meant only to have an indemnity, the very basis of a contract of insurance. Admittedly, it is of course difficult at any given time to be exact or precise about the value of the subject matter insured. A margin of error is bound to occur, and the courts are generally prepared to overlook any difference between the real and the agreed value, provided that it is not grossly or outrageously excessive. Not all overvaluations will be tolerated by the courts, and there are, as will be seen, more than ample grounds upon which the courts may set aside an agreed valuation which is excessive. What constitutes excessive overvaluation is a question of fact. In the absence of fraud. The above phrase embodies the defense of fraud, which could be used to nullify an excessive agreed valuation. Section 27(3) specifically states that the valuation is conclusive only in the absence of fraud. Thus, if a policy is tainted with fraud, the whole policy and not just the agreed valuation is at risk. The phrase "in the absence of fraud" is simply a warning that if there is fraud, not only the valuation but the whole of the policy may be reopened and avoided. Unless the policy is avoided, the value is conclusive. It is of course possible for a valuation to be excessive without being fraudulent. As fraud is by no means easy to prove, this defense is rarely pleaded. It is true to say that it is much more easy to infer fraud from overinsurance of goods than from overinsurance of ship, when both parties are in approximately the same position to know what the market value of the ship proposed to be insured is. Breach of utmost good faith. Besides fraud, there is another defense which could be invoked by an insurer in order to avoid liability. Section 17 on the doctrine of utmost good faith is concerned with conduct of a lesser degree of impropriety than fraud. Conduct short of fraud could attract the operation of this principle. It is to be noted that fraud would render a contract void from the inception, whereas a breach of the duty of utmost good faith would merely make the contract voidable. The principle of utmost good faith is the golden thread running through the whole fabric of a contract of insurance. A valuation known to the assured to be grossly excessive, but not revealed to the insurer, would surely offend the principle of disclosure, and very likely constitute a breach of the duty of utmost good faith. Wagering or gaming. On the facts of the case, the court preferred to rest its decision on the ground of non-disclosure of a material fact. An assured who excessively overvalues his insured property may well find that he has no policy upon which to base his claim. Such a policy could be held to be void by reason of gaming or wagering. Non-disclosure of material fact. Excessive overvaluation could arise in one of two ways. An assured may take out one policy in which he has excessively overvalued the subject matter insured, or he could take out more than one policy on the same subject matter insured, resulting in an overvaluation, or if preferred, overinsurance by double insurance of the subject matter insured. In either case, the effect is the same. An assured who fails to disclose to the insurer that the agreed valuation in a single policy or the total sum of the agreed valuations of more than one policy is excessive would be guilty of a breach of the duty of disclosure. On the question of the knowledge of the insurer, either that he knew or ought to have known that the subject matter insured was grossly overvalued, reference should be made to the case of General Shipping and Forwarding Co. versus British General Insurance Co. Ltd., 1923, where a distinction is drawn between overinsurance of goods and of ships. In this case, the vessel was valued at £5,000 in the policy when her actual market value was about £1,500. The insurers denied liability on the ground that the vessel was grossly overvalued. The judgment awarded in favor of the assured on the ground that the insurers themselves were in as good a position as the assured to gauge the market value of the ship. The judge pointed out that if the policy be on goods, the matter would be on a different footing. There, the underwriter has no means of knowing the value of the goods, except the statement of the assured. He has not, as in this case, all the information to his hand when he comes to insured goods. Unvalued policy. An unvalued policy is defined in Section 28 as a policy which does not specify the value of the subject matter insured, but subject to the limit of the sum insured, leaves the insurable value to be subsequently ascertained in the manner herein before specified. Unvalued policies, sometimes referred to as open policies, are nowadays rarely used. Whilst the valuation declared in a valued policy is accepted by both parties as binding and conclusive in an unvalued policy, the value of the subject matter insured, referred to as the insurable value, has to be subsequently ascertained in accordance with the rules set out in Section 16. End of Part 5. Maritime Academy